Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we are starting today's session on a fairly positive note. There's been some developments over the past couple of weeks on the vaccine news. There's a lot of positivity in the markets revolving around that. We do have rising number of cases here in the US that has put a damper or a cap on the equity markets rally. So as we potentially start to reach a peak in terms of cases and potentially start to bend the curve, and the news last night about the transition or what looks like is going to be more of a peaceful transfer of power between the Trump and Biden administration, this really opens up for potential further upside here for equities. So a lot of optimism going into the markets here today, going into the holidays. So we want to discuss where markets currently sit and the opportunities that we currently have. Before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off with our normal market updates. I want to show you where the sectors and fixed income markets are currently sitting and how supportive they are for continuation higher and which sectors to pay attention to. I do want to review the housing and COVID data currently in terms of how we see opportunities going forward into 2021, as we have a reopening, and even, how do we look for opportunities in the current environment where there is, again, a very elevated number of COVID cases, and then show you some of the ideas off of the data that we're currently looking at. But the primary question that I want to help investors answer is really, have we overcome the hurdles for the equity markets to continue moving higher? We've had multiple hurdles here over the past couple of months, whether it's the rising number of COVID cases, the presidential election, the transfer of power, the vaccines. These are all things that have been on investors' mindsets. So the question is, have we cleared all those hurdles and have our equity markets now ready to rise and continue moving higher? So my name is Tony Zhang. I'm the chief strategist here at Options Play. And what I want to share with you are my charts, my research, and the ideas that I have off of that. So we start off by taking a look at the broader markets. When we look at the S&P 500, the S&P 500 remains above its all-time, its major support level here at around 353, 355 or so. After breaking out above higher on that vaccine news from Pfizer, it's managed to stay above that level. And as we continue to clear these hurdles, especially the peaceful transfer of power from one administration to the next, and as we seem to be, as the number of COVID cases are starting to decelerate, they're still rising, but it's decelerating, and we have multiple vaccines that have seen efficacy rates above 90%, our expectation is that many of them, or at least a few of them, are going to be approved for emergency use within the next few weeks, potential distribution by the end of the year, full distribution next year. Equity markets are forward-looking. Equity markets are looking at and basically holding this major support level and looking for a potential continuation higher here. So if you look at the S&P 500, I do think now we have cleared most of those hurdles and can now potentially start moving higher. When we look at the NASDAQ 100, this is the market that's still lagging behind. We're still looking at that 295 resistance level as a hurdle for it to clear. I do expect here, as equity markets continue to rise, that we're going to start to see the NASDAQ also come back to life a little bit, but Apple putting a bit of a drag here on this major index, which is a very large weight to the index. NASDAQ or technology shares falling a bit behind, but overall, when we look at small caps continue to lead, actually getting to new all-time highs here on today's pre-market. Small caps has been leading this market higher since the Pfizer news and continues to lead the market higher here. This is strong for an equity market rally to see the small caps join in on the rally, and for equal weight S&P 500 also to actually reach all-time highs. This is something that is supportive of this broader equity rally, when it's not just a few mega cap stocks dragging the whole market higher. When you have broad participation of this equity market rally from small caps to the broader S&P 500, that is constructive for a continuation higher here. And if we look at VIX, I would argue that VIX has now entered, since the past couple of weeks, into a new volatility regime. Basically, since the start of the pandemic, we've been in a different volatility regime since before that. So if you look at the pandemic, Pre-pandemic levels, post-pandemic levels, very, very different. And I would argue here over the past couple of weeks, we've probably entered a new volatility regime that looks very similar to what we had here. So what we expect is that volatility is likely going to start heading down into the low 20s, potentially even break below 20 here, as a lot of the uncertainties around the pandemic in terms of how it's going to continue to rise, the number of deaths, the U.S. election. These are all big uncertainties that we've passed these hurdles. And I think for that, what we're going to do is reach a new volatility regime. So volatility is less elevated than what we have seen over the past few months, but it's likely going to continue to get lower here to the downside. So this is going to still favor option selling strategies, selling cover calls, selling cash secured puts, selling credit spreads. And that is very important for options traders to understand the shifts that we're starting to see from volatility. One of the major shifts that we saw here yesterday was the breakdown of gold. Gold has been trading in this triangle for quite some time. We were looking for a breakout in one way or another. We were talking about a potential breakout here to the downside. Yesterday, we did get that breakout to the downside, and we expect that to continue to happen. Now, what has decoupled a bit from gold is actually Bitcoin. Bitcoin continues to rally and has now reached its all-time high back here in about $19,000 that it reached in late 2017. Now, the interesting thing about this is that, we usually think of these moves here in Bitcoin as kind of speculative bubbles, based on just reactionary trading from day traders, a lot of hype. That's not actually what we're seeing here. What we're actually seeing is that this type of buying is being done on relatively low volumes. It's actually a lack of supply that's causing this. So I would continue to watch this $19,000 level. I would expect that you get a bit of a pullback here, but longer term, you could see a breakout above 21,000, 19,000 or 20,000, and that would be another bullish signal here for Bitcoin. We talked about this back here when it was around 13,000, the breakout here. We've had a pretty strong run here to the upside. It might give back a little bit and then continue moving higher here. But gold and Bitcoin have decoupled from each other in terms of using as a hedge for inflation. Gold has not been particularly strong on that. If we look at the U.S. 10-year continues to stay in this uptrend here, maintaining this uptrend channel here. Looks like it found a little bit of support here around the low 82, 83 basis points. Our expectation is still for U.S. interest rates to continue to rise here to the upside. When we look at the U.S. 10-year, and this has ramifications here for financials, XLF. My preference is to use KRE to play for this upside in interest rates because the regional banks ETF is a little bit more sensitive to these 10-year yields. XLF, you have Berkshire Hathaway, you have American Express, you have insurance companies, you have S&P Global that are not very interest rate sensitive or as interest rate sensitive. So, whether you're using XLF or KRE to play for upside, we are expecting, banks, regional banks, large banks are going to benefit from this. So my preference is KRE, but I'm using XLF as a proxy because that's the ETF that most of us are familiar with. When we look at fixed income, HYG, high yield bond ETF, continues to outperform in the fixed income space. If we look at treasuries versus high yield, we see strong inflows into high yield, strong outflows out of treasuries. This speaks to the fixed incomes investors' risk appetite continuing to show that it's increasing risk appetite. This is again supportive of the thesis that equity markets can continue to rally from here despite trading at what is fairly rich valuations by pretty much all possible measures. The one thing that we have seen some movement here on the upside here is crude, but the one thing I will say here, it hasn't moved too much. The crude has pretty much been range bound between 36 and 40, 41 or so for months. We've had that breakout here. It's about to retest this $44 resistance. We're seeing this on light WTI. We're seeing this on Brent. Brent is reaching that $46 resistance level. The question is whether this can rally and continue to move higher here. From my perspective, that certainly is possible, but there's a lot of resistance here going into that $50 level here on crude, which is why when I look at the chart of XLE, we see back-to-back multiple double-digit gains We've had now multiple double-digit gains here in the past couple of weeks on the Pfizer vaccine news, on the Moderna vaccine news, on the whether you're looking at the vaccine news from earlier this week, or if you're looking at the peaceful transfer of power from one president to another. XLE, in my opinion, here has gone a little too far, too fast. Now, how do you play this? This is the difficult part, because as better vaccine news continues to come out, you're likely going to see reactionary plays from XLE move continuing to the upside. But from my perspective, I like these extreme moves more as an opportunity to continue to short these types of names, because again, crude hasn't moved very much. XLE has moved a whole lot. That doesn't really necessarily correlate to the breakouts that we're currently seeing here in crude. The one other segment of the market that we have seen a breakout here is XLI, industrials. Industrials breaking out to new all-time highs, consolidating a little bit here over the past couple of weeks, and looks like it's about to continue to break out here to the upside. So XLI is certainly one of the sectors that I would pay attention to. So XLF and XLI, industrials and financials, we see support of rotation into these names as we get this reopening trade starting to come back to life here. So XLI, financials and industrials are two segments of the markets that we are paying attention to. One area of the market that we haven't talked a whole lot about over the past few weeks is vaccine news has predominantly dominated, and one segment of the market where, if we look at from a performance perspective, it's really lagged behind is housing. But when we take a look at housing data, it still is very, very supportive of this particular segment of the market. Housing starts extremely strong, well above 6.5 million housing starts. Existing sales. Housing starts also relatively strong, about 950,000 housing starts here in terms of single family homes. And we're doing so in an environment where the inventory levels are continuing to decline. Inventory levels are at multi-decade lows if we're looking at existing and a new single family house. So this is why when we look at the housing data, and when we look at the home construction companies, we see some opportunities, especially since after a very strong move here over the past 8 or 9 months. They've taken a pause here over the past couple of months. I think this is now a potential opportunity to look for continuation higher here, and we're going to show you some of the names that we like here for that. In terms of the number of COVID cases, when we look at the growth in terms of the number of COVID cases, we're starting to see a deceleration here in terms of that growth. That is the optimism that I think the equity markets have been looking for, the hurdles that the equity markets have been looking for in order to continue moving higher. During this phase where the acceleration was still at a fairly strong pace, I think equity markets were taking a pause from continuing to rally, especially since vaccines weren't approved yet, even though there was strong clinical trial results, until they're actually approved and we're starting to see some of this bending of the curve. That is really what we're looking for. And we're starting to reach that potential peak here. Some models are showing an early December peak here right after Thanksgiving holidays. And I think equity markets are looking for that peak and continuing to move higher. But the one thing that we have shown over the past couple of months is that mobility has started to decline as the number of cases have started to rise here. Now, the mobility hasn't declined a whole lot here, so I do expect that over the next few weeks that mobility will start to continue to shift higher. And as we start to see that shift higher in mobility, that again is supportive of the broader equity rally. And what we want to simply focus on are some of the specific sectors that are strong and the specific reopening themes that would likely benefit from this type of change or shift in mobility. So when we look at that, the first one we want to take a look at is that home construction ETF, ITB. And whether you use a specific name within the ITB like DR Horton or Lennar or Pulte Group, these are all names that have the same type of price action, where we've had multiple months of extremely strong price action. So what we had was a very strong reaction off of the March lows, a brief consolidation here in the early late spring, early summer months, and then a very strong rally here going into or late August. Ever since late August, the home constructors, whether you use XHB or ITB or any of the individual homeowner ETFs, they've been pretty much range bound here since late August here. And what we're starting to see is the potential breakout here of this consolidation range here to the upside. And I think the housing data remains fairly strong and constructive for this potential breakout. So this is one segment of the market that I do think is worth paying attention to, as we don't think of this as a reopening trade per se. This is actually the opposite of reopening trade, but the shift that we've started to see in terms of how we work from home and the amount of time that we're going to spend at home, that is likely going to be a permanent shift. And that's why this is not quite under the reopening or the lockdown trades anymore. This is really more of a permanent shift that we're starting to see in how this country decides where they're going to live. And I think there's a lot of people that currently live in cities that are going to reverse that, and that's what we have seen, and that is likely going to continue. And that's why these home construction companies will likely to continue to benefit. On the other side, one of the things that we still continue to see some improvements on are airline traffic, especially if you look at some of the routes operated by regional jets and 737s and Airbus A320s. These are more shorter flights, domestic type flights. Within Europe, you're talking about within Europe, these types of flights. Within Asia, we're seeing almost a return back to normal in 737 and Airbus A320 flights, only about 20% below pre-pandemic levels. It's really the wide body, the 747s, the Dreamliners, the Airbus A350s that are seeing 40-50% declines from the same time last year. So wide body suffering substantially versus the narrow body jets. So when we look at that, the Jets ETF is back to its $22 high. So we've had this test of $22 high in early June. That was just a little too early. We had a very strong reaction to the vaccine news from Pfizer and Moderna over the past couple of weeks, test that $22 level, and now we're coming back to retest that $22 level. So now is the potential for a big breakout here to the upside. That is why one of the plays that we have here for this week is Southwest Airlines. When we look at Southwest Airlines, this is really one of the airlines that are focused on leisure and domestic travel. So when we look at their Southwest Airlines, their entire fleet is 737s. That's their business model. They operate shorter domestic flights. They focus just on leisure. They don't have any corporate travel or virtually zero corporate travel. And that is the segment of the market that we believe is going to recover fastest and get back to normal faster than other ones. And if you look at Southwest, Southwest is better capitalized than any of the other airlines. They have a substantial amount of cash. They have very little debt. And they're actually, in this time, one of the only airlines expanding right now. They're basically taking advantage of the fact that Delta, American, and United are actually contracting their routes. They're figuring out where to cut back. Southwest is taking advantage of that and actually increasing their number of flights that they're going to be operating, and that is likely going to pay dividends as we have a reopening, as the number of COVID cases decline, as a vaccine gets out there. So Southwest Airlines, our top pick for that reopening trade. When we look at Disney, this is one that hasn't been on our radar too much because there hasn't been a whole lot other than the recent earnings announcement that made it pop quite a bit here from the high 120s into the low 140s. Now I think this is really where you can have another opportunity for a breakout play here for Disney. Disney is really an interesting thing because it's both a lockdown and a reopening trade at the same time, because Disney obviously operates the theme parks, which have been hit substantially as lockdown. And then they also operate the streaming side or the media side that has generated a lot of traffic or interest during the lockdown state. So regardless of whether you are looking for a reopening or a lockdown trade, Disney is really kind of at the intersection of those two. So we're really, as you can see, the theme here is really some of these names. And interesting, someone just asked about Uber, but my top pick on the reopening trade from this perspective is actually Lyft. And simply just from the fact that Lyft is a little weaker here. And as you can see, this $41, $42 level has been a major support or resistance level for quite some time here. And what we're looking for is a potential breakout here. And it's just on the verge of this breakout. And obviously, reopening vaccine news, that is the type of optimism that the market is looking for that breakout here. And you have a fair amount of upside here into the $48, $50 level here, all the way into this prior high here. So Lyft, in my opinion, has more upside here. As far as Uber goes, Uber certainly leads the rideshare market, but Uber has a lot of other businesses that they're invested in. They're competing very heavily on Uber Eats. Grubhub just filed for IPO. There's a lot of competition in that particular space, and it's not a profitable business yet. And I think this is really one of the concerns that I have with investing in Uber as they continue to fight for dominance in the food delivery space. Lyft is not doing that. Lyft is focused on rideshare. It's a little bit more, it's smaller, it's focused. I like that a little bit more than playing Uber per se. So that covers the ideas that I want to share with you, the themes that we're currently paying attention to. We're going into a light couple of trading days. Tomorrow is going to be a thin trading day from a volumes perspective. We could see a melt up, as there's more optimism. We could see some pretty big moves to the upside because just thinner liquidity. Same thing here on Friday. Friday is a half day for trading. Liquidity tends to be thin. If there's any type of good news, we're likely going to see exaggerated moves to the upside. So be careful. If you're trading these markets, they're going to be a little thinner. Liquidity is not going to be as strong, but we may see some big moves as a result of that. So we do have a few minutes here, and I'll open this up for Q&A if anyone has any questions here. So please, if you have any questions, you can type it into the chat window, and I'll try to address a few questions here before we sign off, and wish you everyone a happy holidays. So what do you think about oil stocks? I've already covered that, and I covered Uber. When Hertz gets delisted and files Chapter 11 on October 30th, should long put options exercise to the max? No, because just because you file for bankruptcy doesn't mean that your stock goes to zero per se. The stock can still trade at a certain amount. So, I don't know about Hertz per se. Let's see. What's the... Hertz was delisted. That's a good question. I would have to do a little bit more research, but the OCC, you would want to go to the OCC website. They would be able to help you with that in terms of how to handle, your options. I'd have to do a little bit more research specifically. What do you see about EV stocks? So when we look at EV stocks, like NIO or XPEV, there's no doubt that there's a lot of relative strength and momentum behind it. The one thing I will say is that the fundamentals do not justify the current stock price. These are stocks trading on hype. These are stocks trading on the fact that they're fairly thinly traded. It is obviously an industry that is extremely, I think people are thinking long term. So from my perspective, EV stocks, if your time horizon is 5 to 10 years, which is, if you look at the electrical vehicle market and you're thinking about, the fact that China's trying to move to completely carbon neutral by 2040, which is an extremely ambitious goal for a country with over 1 billion people. You look at what California is trying to do by 2035 of having all electrical vehicles. If your time horizon's that long, these are stocks that I think are more than, picking up these stocks at these particular prices are reasonable because your time horizon's that long. But the fundamentals do not justify the current stock price if you're looking at the current fundamentals. So if you're a short-term trader, be careful of the volatility. If you're going to trade these with short-term calls and puts, the best advice that I have for you is take profits often and take profits early because things are very volatile. You could have joined in on that rally and lost all of your money the very next day and then made all your money back the day after. If you're comfortable with that type of movement, by all means, just be very, very careful. These are the types of names that most people make a lot of money on a very short amount of time and then lose a lot of money over a very short amount of time. So the question is really, what's your time horizon? Short term, if you want to play short term, be very, very careful. You have to be extremely disciplined as to when you cut your cut your losses, when you take profits. If you're a long-term investor, if you're thinking over the next few years, next 5 years, next decade, I think that these are stocks in its infancy that are likely going to continue to grow. Whether you're looking at Tesla, whether you're looking at NIO, whether you're looking at XPEV, all of these, from my perspective, I wouldn't necessarily pick one, I think you want to diversify across a couple of the small caps like NEO and XPEV, and then also at the same time take advantage of Tesla and then even GM. GM, as you can see, one of my top picks. I like GM. Around $30, I picked up some around $30. This is a large cap player that really is focused on EV. Not something that I think was on most investors' radar earlier in the year, but they have focused their attention over the next 3 to 4 years on just electrical vehicles, and we're seeing that in the stock price. They also have an option effectively on Nikola, so a little bit different from EV on the hydrogen cell side. So those are all ones that I would put in my portfolio if you're thinking in the long run. Tesla, broke out here from that $500 level here. So I certainly think that this can continue moving higher here. There's no doubt in terms of the momentum and strength here for Tesla. Tesla did, consolidate for quite some time here between this $500 and $400 level. You've gotten that breakout here. So from my perspective, it can continue to move higher. It's just basically trading on momentum here. We talked about gold. We broke down on gold here. I think gold is going to continue moving lower here. I thought lowering volatility suggested buying instead of selling. Now, generally speaking, low volatility is good for buying, but not if you expect volatility to continue to move lower. That is likely what we see is extended periods of lower volatility. Now, the fact that 22 is still elevated compared to where we were before. So I think that volatility is going to continue drifting lower here, which again favors selling volatility rather buying. Buying only works if you think it's near the absolute lows and it's now going to rise. And what I'm saying is that what we've seen is a shift in volatility, that what we're saying is low compared to the pandemic is still high compared to the new regime that we're going to enter. Zoom going from here. So Zoom, I think is what I would consider fully valued or fairly valued at this point, given the fact that people are still going to continue to work from home. People are still going to continue to educate from home. Lessons from, whether you're working out at a gym or music lessons are likely to continue to happen on Zoom. So Zoom, I think, is still going to be fairly valued around here. I don't know that there's a lot more upside. And I think that there is potential downside here if the recovery happens at a faster pace than we expect. So I think Zoom is more likely to move sideways, and the downside and the risks are skewed a bit more to the downside. And so with that, I just want to thank everyone for taking the time out here this morning. I hope that this was helpful in giving you a better understanding as to where we currently sit in the broader markets. Like I said, over the next couple of days, things are going to be thin. Be careful, but overall, largely, we're fairly bullish here on the equity market. So with that, thank you so much. I hope you guys have a great holiday, and I'll see you guys next week.